Are you either looking for or already using a trust to run your business? Or maybe you're looking to hold investments in a trust and wondering how the tax is going to work? Today's video is for you. Hello everyone, my name is Ethan Rooshock. I'm the director here at Rooshock Accounting, and today's video is all about tax when it comes to trusts. I'm going to be going through the fundamentals of tax when it comes to trusts, including the two main types of trusts, how a trust calculates its taxable income, how it then distributes that income, and what happens to the leftover funds. So to really understand how tax will work on a trust, we need to understand what type of trust it is. And there's two main types of trusts that we have here in Australia. We have discretionary trusts and fixed unit trusts. A discretionary trust has its taxable income, and then it's up to the discretion of the trustee on how that is distributed to the beneficiaries. So this is decided each year via a trustee distribution resolution, and it can be different each year. So for instance, if we had $10,000 of income and we had 3 different beneficiaries, we could give $8,000 to beneficiary A, $1,000 to beneficiary B, and $1,000 to beneficiary C. So you can see that this could change and gives you a lot of flexibility from year to year. We then have a fixed unit trust, and these distributions are going to be based on the percentage of units each holder owns. So for example, we might have 2 different owners. One owns 75% of the units and the other one owns 25%. And we've got that same $10,000 of income. Well, this time we don't have any decisions to make because $7,500 will go to beneficiary A and $2,500 to beneficiary B. So you can see this gives us a lot less flexibility compared to a discretionary trust, but fixed unit trusts do play their roles in certain situations. So does a trust itself pay tax? Well, in most situations, no. The trustee of the trust will only pay tax in 3 situations. Now that is for distributions made to non-resident beneficiaries, for distributions made to minors over $416 in most situations, and for any funds that aren't distributed. Now the reason why this rarely occurs is because the trustee will pay at the highest marginal tax rate. So that is currently 45% plus the 2% Medicare levy. Now, clearly this doesn't happen very often because it normally works out better to distribute those funds out to the beneficiaries because they're going to be on either a lower tax bracket or worst case scenario, the same tax bracket. So in most cases, no one leaves funds in a trust unless there is something in the trust deed that dictates that's what is meant to happen. Now, beneficiaries will then go and pay tax on their taxable distribution at their own marginal rates. And they are distributed the segments of income from the trust. So for instance, something like capital gains will be distributed to the beneficiaries and then assessed at their individual level. So for capital gains, for instance, they will look at discounts and losses and they will be all applied at an individual level, not at the trust level. And how much tax is paid will depend on each beneficiary. Some beneficiaries might have no other income and just receive $10,000 and pay no tax. Others may receive $10,000 and already be on the highest tax bracket of 47% and therefore pay $4,700 in tax. It will just depend on your own individual marginal rate. Now, a trust can't distribute its losses in most situations, but those losses will roll forward to future years to be utilised against future profits of the trust. Now, a trust does still need to work out how much taxable income it has got so it can work out what can be distributed. So at a basic level, this is going to be income less expenses is your profit. Now, income will vary depending on what activities the trust is carrying out. It could be a business is running its operations, or maybe it's investments and you're earning interest or dividends, or maybe you've got some capital gains events there. The expenses of the trust will again depend on what you're doing. It could be general business expenses, or maybe you've got some investment expenses, accounting fees, for instance. Once you've worked out what the net income of the trust is, you can then go and distribute the taxable income to the beneficiaries. Now again, I've mentioned this on previous videos, there is a difference between tax profits and accounting profits, so make sure you speak to your accountant so you really understand what is actually going to be distributed to the beneficiaries. So to summarize, there are 2 main types of trusts. The most common that is used is discretionary trusts. They have the discretion to distribute the taxable income of the trust to the beneficiaries each year. This normally happens because then the income will be assessed at individual levels at their marginal rates rather than the highest possible rate if it is all left within the trust. What topic do you want me to cover next? Drop a comment down below and make sure you've hit that subscribe button, and I'll talk to you again on the next video.